Ladies and gentlemen, this is the podcast for Topic E, which is capital budgeting. We'll be doing 4 problems, which is similar to what we have done in the past, except in the other podcasts, except that Perelman lumber will not come out of your textbook. It comes out of the handout for class. It's on the back of the capital budgeting handout. So let's start then with problem 3.4. Now problem 3.4, Just One Inc. has 2 investment projects, and given market interest rate of 10%, they have information on both the internal rate of return and the NPV. The ranking of the projects differs depending on which one you use. In the case of NPV, of course, the highest is project P. In the case of internal rate of return, Q is ranked highest. And the question on the table is which project should be selected. Why is the internal rate of return ranking misleading? Well, the internal rate of return ranking is misleading because the scale of each project is different. While Q has a higher internal rate of return, it's a smaller project and yields fewer dollars of net present value. So depending on the size of the project, the 2 internal rate of return and net present value can give quite different results. But internal rate of return is size dependent. And to a certain extent, so is net present value, because the opportunity to make returns is very much a function of both the size and the opportunity that the subunit faces for the project. Some subunits will never get projects that pay that as high a rate as other subunits. Let's move on to problem 3.7. And in problem 3.7, Northern Sun, we assume no income taxes. In fact, we assume no income taxes for the next 2 problems. But we've got a table of cash outflows, and in that projected cash inflows and outflows, and a food processing concern that's considering a new line of frozen entrees, and these inflows and outflows relate to those frozen entrees. The company's cost of capital is 10%, and they want you to compute both the net present value and the payback. Now the net present value, starting with an outflow of $355, which is your net outflow for the initial investment, and all inflows and outflows are deemed to be received at the end of the period, is where we start, and then we have inflows in subsequent years. All are discounted by 10%, giving us a positive net present value of $147, which in theory is a take signal. Actually, you would never take something that small, but we'll presume they're missing 5 zeros. Anyway, the part B asks you to do the payback. And here, this is an example of a payback with uneven cash flows. The payback starts with the first year of inflows. The total investment to be recovered is $355, which is the total outflow at time 0. And so the initial investment. You notice that the initial investment is not covered in year 2, nor is it covered in year 3, where the cumulative cash flow is $245. So 55 in year 2, 190 in year 3. We still have 110 outstanding. Now the next year's inflow is 240, so we'll more than cover the payback or initial investment in year 4. However, we will cover it part of the way through year 4. So at the bottom you'll see a calculation of the partial year payback of 110 divided by 240. So we have a payback of 3.46 years. So we have a relatively quick payback, positive NPV. We probably have a take signal for this project. Now in 318, again, we're ignoring income taxes. We have capital expenditure on a freezer system. And the question is, do we keep the old freezer system or get the new freezer system? Now this particular problem contains both important qualitative and quantitative issues. Let's take a look at the quantitative first. If we take a look at the old machine, we'll see that it has the net present value of keeping the old machine without respect to any taxes is $18,450. There's a repair that's outflowing, and then the present value for profits of $5,000 a year for 5 years. You treat it like an annuity, multiply it by 3.890. So we have a total net present value of keeping the old machine of $18,450. The new machine has an outflow of $5,000. Now, there is a present value of the inflows of $25,285, and in addition, we get $500 for selling the old machine. So the net effect is a net present value from purchasing the new machine of $20,785. So the net present value of purchasing the new over keeping the old is $2,335, and that is without looking at the tax benefits offered, because we are allowed to keep claim CCA on the new machine. So it looks like a positive take signal. However, quantitatively, we have to be very careful, because these are freezers. This is a food business. If the new freezer system is more effective in keeping the food frozen, then you really have to consider whether keeping the old freezer system is worthwhile from a safety perspective. A bad freezer system can cause the food to be contaminated, and the losses are not included. Potential losses from that contamination are not included in this problem, as is frequently occurs, because you can't quantify all of the aspects of these decisions. Frequently, you just have to raise the issue that there might be some missing data. In this case, the possibility of the old machine breaking down and food being spoiled. Now, the last problem is found in the handout number 6 in your on the web, in your lists of additional materials for the course. It is at the end of the capital budgeting handout, and this is a common problem that happens. Pillman Lumber is a family-owned business, makes furniture, and the mother, who is the granddaughter of the original founders, is currently trying to assess how good her son is. This frequently occurs in family businesses, particularly where there's more than one family member that is a potential candidate to take over the business. The potential candidates will face various decision tests. This is one that his mother has set him regarding him being her son, Henry Tyler IV, to see whether he's able to make a very basic management decision whether or not he should replace an existing machine. Now, there are two opportunities on the table. There's a basic machine and there's a machine that it's called semi-automatic, that would eliminate some of the manpower, particularly the manpower in the so-called tailors, as well as to reduce the maintenance costs over a period of years. And the question is, which of the two machines produce a positive NPV? The time horizon for the decisions is given 7 years by Mrs. Tyler, and she feels given the pace of technological changes and potential regulation, that the small business has a rather uncertain future facing it, so she wants a smaller payback time. So she expects a payback in 4 years or less, and her after-tax return on investment, it has to be at least 16%. So the question then is, with this machinery being classified as Class 39 or 30% for tax purposes, whether this either of the machines or both meet Mrs. Tyler's criteria, and if both do, which of the two is the better purchase. So the assumptions then for the machine purchase again are 7-year time horizon, a discount rate equals to 16%, and a corporate tax rate of 46%. And these are stated in the problem. Now the things you have to consider, and it doesn't matter in what order you consider them as long as you capture all of them, are both capital and operating effects of these potential purchases. Now, for a basic machine, I prefer to separate the capital from the operating as far as I can. So, with respect to capital inflows and outflows, the salvage from the old machine is $5,000. Remember, it comes through into the hands of the company without any income tax effect. It's received at time 0, so it's not discounted. The cost of the basic machine is $125. Now the CCA for the 7 years is $34,383, and the salvage value from ultimately selling the new machine at the end of year 7 is $1,770. The details of the CCA benefit are coming up, but the present value of the capital expenditures, both inflows and outflows, are $83,847, and that's without considering the operating effects. The next slide shows the operating effects. Here we have labor savings in the basic machine of 1 feeder, 1 tailor. Now with benefits and after tax and discounted as an annuity, we have over 7 years we've got benefit from the labor savings of about $55,000. The maintenance savings for the first 3 years are extremely high, much higher than the latter 4. And again, because these are deductible for tax purposes, only the non-deductible portion is considered to be a benefit. And again, you're looking at an annuity from year 4 to 7 that's different from the annuity from year 1 to 3. So we have different annuity factors, and the present value in total of the operating savings is about $99,000. So $99,329. Now the net present value, looking at the capital outflows and the operating inflows, is $15,482. So it's positive. Now the details of the CCA benefit are included here, and you'll see that that it includes the loss of the edge as well as the edge formula. So there's $34,000 for the original edge formula minus 531 for the loss of the edge. Let's take a look at the second machine, the semi-automatic. With this machine, we're assuming no manual tailors are needed, and the capital outflows in this case are 137,157. The CCA claim, the benefit is 55,011, higher than the other machine because the semi-automatic machine costs more. The salvage from the sale of the old machine is included as it was in the first example at $5,000, and the salvage from the sale of the new machine, which has a value of $8,000 at the end of 7 years, is again a higher amount, given the greater value of the machine. Now the operating savings are about 142,033, which is the maintenance savings, again similar to the first machine. The maintenance savings are heavily weighted towards the first 3 years of ownership. Remember that the labor is the amount they pay plus the benefit, so it's multiplied by 1.2, and because labor is deductible, it's the after-tax 0.54. It's the saving times the annuity for 7 years. So the net present value, looking at the capital outflows and the operating inflows, is 4,920. Details of the CCA edge formula are here. The edge is 55860 minus the loss of edge of 849. And now when we look at payback, so both machines are showing net present values that are positive. Now when we look at the basic machine versus the enhanced machine, we'll see that the cash flows are involve a year payback for the basic machine in year 5, and for the enhanced machine in year 6. This means neither of the two of them meets the payback period requirement set by Henry's mother, although both of them have positive NPVs. Now the other thing you have to consider is the new machine, the enhanced machine, will involve a layoff of a number of employees. This is a family business. It's likely those employees have been working for the company for a long time, and it's also likely that there's going to be some unrest or unsettled work, worry in the workforce about whether they will all lose their jobs. And so you want to be careful about laying off a lot of employees, and perhaps the basic machine is the better selection. It has the earlier payback, and in addition, it lays off the least number of people. But that is really up to his mother. I think it's up to Henry to put forward a solution, but his mother will make the ultimate decision, particularly given the fact that neither of these two machines meet her criteria. And that is the end of topic E. And the next podcast will be for topic F.